The Australian real estate market is valued at $11 trillion. That's $11,000 billion. And that's 60% up from 2010. And among those years, one surprising thing is that the majority of the growth is in 2021. In that year alone, there was a 23.5% gain, the strongest annual growth in recent history. If you think about it, 24% gain in 1 year is a significant amount, especially when you're talking about real estate. And when you factor in the fact that most people have 5x leverage because they put down 20% for their deposit, a 24% property market gain is around 120% gain for them. With such gains from the financial market, you might think we are in a bullish and very healthy economic environment. Well, the story is a bit different, since the financial market only serves those who have capital or assets. The economy, on the other hand, includes everyone, even those who don't have any capital or assets, which are the majority of people. As a matter of fact, in September 2024, Australia's GDP grew by only 0.3%, the slowest since the early 1990s, excluding the COVID period, of course. Per capita GDP declined by 0.3% in the same quarter, representing the 7th consecutive quarterly decline and the longest stretch of negative per capita GDP growth ever. Lastly, as of late 2024, Australia's unemployment is around 4%, with projections of it rising to around 4.2 to 4.3% in 2025. Therefore, you can see a big gap and a big difference between the financial market and the economy. And with such a contrast, it begs the question, do I think our market is sustainable? Probably not. Do I think we are in a bubble? 100%. So in this video, I'm going to discuss the current $11 trillion Australian housing issue. I'll then reveal Ray Dalio's system and how it relates to the current Australia's debt problem. And lastly, I'll uncover how you can protect your assets and your investments throughout the pending crashes. Before we start, if you guys would like all insights about real estate cycle, property, stock, or crypto, make sure you subscribe to my newsletter in the description down below. It's all free and it got a lot of sauce, so make sure you check it out. Alright, let's start with the current $11 trillion Australian housing problem. With the housing market, the first area of focus we need to look at is the debt to GDP or debt to income ratio. In 2010, this was 200%. However, from 2020 to now, it's a staggering 300%. This means for every dollar income Australians earn, they gotta pay triple that in debt. Now that's just total debt, but when you look at the monthly outgoing cash flow for mortgage repayments, so debt servicing costs, it is now at 20%, the highest it has ever been in history. But that's not all. That's just pre-tax income. If you account in post-tax income, this can come up to 30%. And this figure is for a household family as well. And household is usually 2 people paying. So if you're a single parent out there, and I know quite a few, that's almost 60% of your income paying mortgage repayments. Meaning more than half your income paying the monthly mortgage. In my mind, I always wonder, how is that person going to survive with a remaining salary with high cost of living like today? Their salaries do not leave room for margin of errors. If the GFC hits, they probably won't make it through if they lose their jobs. So out of curiosity, I've asked the people that I know with these questions to them, and they've told me 2 things. It's either they think the market will always keep going up because the real estate agent told them so, or they think they will just sell right before the top of the market. And there's a few flaws with those answers. Now firstly, markets have ups and downs, and with real estate financial crises, sometimes the downtime can be 3 to 4 years. Secondly, most people don't see the crash coming, just like how most people don't see the GFC coming. Therefore, they aren't prepared and they will always suffer. Because when the downtime comes, and it will come, lending slows down, companies go bankrupt, jobs will be lost, and when you no longer have a job to service your mortgage, you will lose your home. Banks and companies that rely on you paying your debt will go bust, and this will trigger a domino effect on everyone. But right now we still have some time. We are not even near the top of the market, or we are not even at the peak yet. We are just about to enter the frenzy or the mania phase. At the same time, we've been hearing about the government hinting at reducing the interest rates, and when they do, the market will skyrocket. And when that happens, everyone will suddenly become the next Warren Buffett. Your average Joe and the next door stripper will suddenly own 3, 5, 10 properties. So it's very important for us to understand where we are in the cycle to prepare. Which brings us to the second point, Ray Dalio's system and how it relates to the current Australia's debt problem. Now, who's Ray Dalio? Ray Dalio is the founder of the world's largest hedge fund, and he's predicted almost every crisis. The GFC, the China's debt crisis, COVID-19 crash, etc., etc. In fact, he's so good that in the 2008 GFC, he's made roughly $8 billion when the whole market was crashing. Therefore, I do think his creditability and his past performance do give good guidance about predicting crashes and navigating markets like Australia. Specifically, there's one system he's used and shared in many of his books, and I'll uncover them right now. The system includes, firstly, an analysis of the debt to income or debt to GDP ratio. I've mentioned this before at the start, but it's mainly just describing the portion of your income that represents your debt level. The higher this figure is, the more unlikely it will be for you to pay off your debt. The second figure is the property price to income ratio. This ratio depicts how many years it will take to buy a home. A higher figure indicates how unsustainable it's going to get until people can no longer support the market. The third ratio is the leverage ratios among banks, or debt to equity ratio. This is an important one since banks are the backbones of our country. This ratio indicates how much debt banks have. It details the amount of cash and short-term assets they have that are ready to absorb the losses out of their loans and investments. The higher this ratio, the more debt a bank has, the more unlikely they are to repay the debt. If this ratio across banks in Australia is high, it's a very, very bad sign. So prepare to see risk of bank crashes, bank runs, currency devaluation, and home losses. And lastly, to aid the leverage ratio is the number of defaults and late payments on debt obligations between businesses and banks and people. This one is one powerful one because it literally shows you the reality of if people are paying back their debts on time or even at all. Of course, the higher it is, the more alarming the state of the economy is. Well, there you have it. Those are the ratios that Ray Dalio uses. Now let's apply them to the Australian market. Regarding the property price to income ratio, in Australia, it's now at 17 times. It means Australians would need to spend more than 17 times their annual disposable income to afford a home. That means the average Aussie needs 17 years to buy a home outright. 25 years ago, it was only 9 times. So as you can see, prices have gone out of control and it's gone up significantly more than it was before. Eventually, as this figure goes higher and higher, people's income will no longer be able to support the property demand regardless of government's intervention, unless the government somehow thinks of schemes like the 100-year mortgage, where you can pass down your mortgage to your kids and grandkids. You might think I'm joking about this, but it's actually a real thing, and Japan has tried this before, and I'm not surprised if the government even tries this again. But at the end, there's always a limit on how far this can actually go. Now let's look at the leverage ratio among banks. As of now, the average leverage ratio is 2.67, nearing the GFC high of 3.02. This means for every dollar of equity the bank has, it has more than 2.5 times of that in debt. We have to be cautious of this. It's because in a very severe financial crisis, when asset values can drop sharply, as they did in 2008, the cash and assets banks have might not be sufficient to absorb large losses and debt repayments. Even worse, we've seen an increase in riskier loans from the banks, Stage 2 and Stage 3 loans increasing risk in the last 5 years from 13% to 19% exposure. Now, to really confirm our hypothesis, let's also refer to some numbers on the rising default and late payments on debt obligations. I want to look at the construction industry since it's the only thing I've been hearing on the headlines lately. In 2023, overdue payments for construction companies reached their highest level since 2021. Particularly, we have a 1.77% default rate, which is significantly higher than any other industries. And last year alone, almost 2,000 construction companies entered administrations, a 33% increase from the previous year. Additionally, the construction sector now accounts for mainly 30% of all insolvencies in Australia. 1/3 of the whole country represented by one sector. That's quite a significant change if you ask me. And the fact that this is happening to the construction industry out of all industry is a very big thing. Because according to Ray Dalio and the 18.6-year real estate cycle that predicted all crises from 1999 internet bubble to 2008 GFC to COVID crash, every debt crisis starts with the construction industry first, then the effects get passed down to the consumers. This is extremely true, especially for the property market. How does it work? Usually when we are near the peak, around 3 years from it, the construction industry tends to have profitability problems. Because around this time, the commodity cycle is usually in its bull run. Thus, the commodity prices go up, increasing the cost of building for the construction industry. This means fewer and delayed property projects, reducing the supply to the market. This pushes property prices up and fuels the mania, which is the last stage of the cycle. Now, just a reminder, if you don't know the 18.6-year land cycle, it's a cycle developed by Fred Harrison, a famous British economist that has built the cycle based off the last 200 years of economic data. And it's the same system that many well-known property investors have used to leverage their wealth. Now back to the issue at hand. Once property prices get pushed up and the projects get delayed due to increasing material cost, developers have to wait for a while to finish their projects. As a result, all property projects are delayed at the same time, and eventually all the delayed construction projects will start all together at once, where property prices are now sky high and it becomes profitable again to build. And after that, they will eventually reach completion simultaneously and flood the whole market with supply to aid with the crash. Even worse, at the peak of the market, most people are still highly leveraged, having negative cash flows every single month, betting that prices will keep going up forever to sustain their negative gearing. However, if property prices do decline, homeowners and institutions who are highly leveraged will struggle to refinance or sell their properties, leading to higher default rates and start of the crash. So knowing all of this, how does one protect themselves against crashes? Well, there's a few ways. Firstly, a very common approach among the best investors would be to reduce your exposure as we head near to the peak. In this case, somewhere around 2026, 2027, according to the 18.6-year land cycle. This means if you have a lot of crypto, stocks, or properties, perhaps selling them as we gradually get there. The second approach is for those who are highly leveraged with properties. This includes trying your best to pay off your debt and reduce your debt level. Once you're at the peak, you want to have zero debt, since the peak tends to be associated with an increase in interest rates, which will mean higher repayments while your property prices go down. The third approach is to buy assets that tend to do well during crashes. One asset that stands out to me is gold. For example, in the 2000 dot-com bubble, gold prices from 2001 to 2004 increased by 53%. In the 2008 GFC, gold initially dipped and dropped as investors sold their assets to cover losses, but quickly rebounded with a 63% increase. And lastly, in 2020 COVID crash, gold showed a 36% increase in 8 months. Well, there you have it. Do let me know what you think of this issue of the Australian market in the comment section down below. And if you do want to see further insights about the market or real estate, crypto, and stocks of the cycles, make sure you subscribe, because I will be revealing the rest of my findings very soon.